Hi class, today we're going to be looking at variance analysis and we're going to be working in chapter 9. Hold on just a second, let me get myself set up. We're going to be first looking at cornerstone exercise 9.3, and you should be able to see this on your screen now. We're going to be calculating today direct labor rate variances and direct labor efficiency variances. We're going to also be looking at some overhead variances that will come in the next exercise that we're going to be doing. So we're going to be Guillermo Oil and Lube Company, and we're a service company, and we offer oil changes and lubrication for automobiles and light trucks. On average, Guillermo has found that a typical oil change takes 24 minutes and 6.2 quarts of oil are used. In June, Guillermo's Oil and Lube had 980 oil changes. Guillermo's Oil and Lube Company provided the following information for the production of oil changes during the month of June. And they've given you the actual number of oil changes that were performed, the actual number of direct labor hours worked, the actual rate per direct labor hour, and the standard rate per direct labor hour. In part 1, they want us to calculate the direct labor rate variance. And so to do that, you're going to need to know how to do a formula. The formula for the direct labor rate variance is to take your actual rate, subtract your standard rate or your budgeted rate from that, and that'll give you a difference, which we call a variance. The variance then is multiplied by the actual hours to get the direct labor rate variance. In this problem, the actual rate was given. The actual rate was $14.50 per hour. The standard rate was also given at $14. The difference between these is 50 cents. Because the actual rate is more than our budgeted rate, then the variance is going to be unfavorable. We're going to multiply our unfavorable variance times the actual hours. The actual hours was given at 386 hours. So when you multiply 386 hours times the variance of 50 cents, it gives you a unfavorable direct rate variance of $193. So what this is really showing us is that when we budgeted, we only budgeted $14 per hour. But what happened was actually we paid our employees a little bit more per hour than we had anticipated. This $193 may have been foreseen, it may have been unforeseen, but your company is going to have to make the decision as to whether or not this is a material amount or an immaterial amount. If it's a material amount, we probably wouldn't need to investigate it further. But if it's something that we think that happened just from normal operations, then we won't investigate it any further. And usually it has to do with the amount of the variances. The next variance that they ask you to calculate is the direct labor efficiency variance. The direct labor efficiency variance is based on your actual hours versus your standard hours. Your actual hours in this case were given at 386 hours. Now they did not give us our standard hours, so you're going to need to be able to figure out how to get our budgeted standard hours. And in this problem, they told us, and this part right here, that they were estimating that it was going to take 24 minutes for each oil change. And so, because it takes 24 minutes for one oil change, we would need to multiply that 24 minutes by the actual number of oil changes that we performed, which was 980. And what that will give us is our standard hours. So 24 minutes times 980 would give you the total minutes, but then you have to divide it by 60 minutes to get the hours. They want this in an hourly amount. So don't forget that. You need to divide the total minutes by the number of minutes in an hour to get the number of hours. 392 is the standard number of hours. We're going to compare it to what actually happened, and you can see that it's a negative amount here, which means it's going to be a favorable variance. And that's because our actual hours were less than what we had budgeted for. We're going to take this variance, our difference, and we're going to multiply it by the standard direct labor rate, which is given at $14. When you multiply that by the variance, it tells you the total amount of the variance, which is $84. In the next part, they want you to calculate the total direct labor variance for June. So what we're going to do is we're going to pick up our direct labor rate variance and combine it with our direct labor efficiency variance. This sometimes is called the time variance. Instead of efficiency is the word there. But we're going to add our rate variance and our time variance together. And what that's going to do is that's going to determine our total direct labor variances for June, which is $109 that is unfavorable, simply because our unfavorable was more than our favorable variance. They had a what if analysis on this problem, and it says, what if the actual wage rate in June was $12.40? What impact would that have had on the direct labor rate variance? Well, it changes the direct labor rate variance, as you can see here. And what I did is I just put this back through the formula that we used before, and instead of using the actual rate that they gave us the first time, we're changing that actual rate to $12.40. So that's going to go there. The standard rate is $14. That was given. The difference between the two is favorable. The favorable variance amount times the actual hours will give us the direct labor rate variance. So if the actual wage rate was $12.40, it made our variance become favorable at $617.60. The direct labor efficiency variance, you'll notice, stayed the same. Nothing changed in that, because the only thing that changed was the actual rate, and we don't use that again. When you combine the two of them together, then it would definitely make a difference in the total direct labor rate variance, because it now would become favorable. These two would be added together. Now, something that they did not ask you to do was to prepare the journal entries, but you're going to need to know how to prepare journal entries. So I'm putting this into this particular problem. I want to demonstrate how you would do that. When we're preparing the journal entries, if we're using a standard costing system, in a standard costing system, all of our inventory accounts, materials, work in process, and finished goods, are going to be carried at budgeted cost, at standard cost. Actual costs are never entered in the inventory accounts. If you come up with an unfavorable variance, it's going to be debited in the journal. If there is a favorable variance, it will be credited in the journal. We're going to be doing the journal entry based on the what if analysis, which was the last analysis that we completed. And that's this analysis right here. One thing that is different from the materials journal entry that we talked about the last video that we made is that with your labor variances, you combine them together. Instead of making two separate journal entries out of these, we would combine it together and just have one journal entry. The work in process account is going to be debited for the standard hours, which is your budgeted hours, times the standard rate. You'll remember that our standard hours were 392 hours, and we will multiply that by the standard rate, which was $14, which was given. So the standard hours of 392 is going to be multiplied by the standard rate, which was $14. And that will give you a total of $5,488. That would be increasing the work in process because we are talking about our labor. Since both of our variances are favorable, what they did is they took the direct labor rate variance and credited it. Remember, favorable variances are always credited in the journal. Your direct labor efficiency variance was also favorable, so we credit it in the journal also. And then our wages payable would be credited for the actual hours times the actual rate. This is a liability account. It's always got to be placed on the books at what actually happened. You don't use budgeted amounts for liabilities. You get in trouble by doing that. So you want to make sure that you pay everything that is owed to your employees. So the actual hours times the actual rate. The actual hours were 386 hours that was given. And the actual rate was also given at $12.40 for a what if analysis. So the actual hours times the actual rate gives you this credit amount. And if you were to add all your credits together, it's going to equal this debit to the work in process account. Remember, your labor is increasing here, which will also increase the inventory account work in process. That's why it's debited. So those are your labor variances, and it's a good idea to learn these formulas. On our next problem that we're going to do, we're going to talk about a controllable variance, and what they're calling it in this textbook is calculating the total overhead variance. And the old textbook that we used in ACC 121, we called this the controllable variance. And you'll remember that the controllable variance was based on variable overhead rates. So they've given us some information about this company, the Standish Company, for the month of February. And they've told you the units produced, the standard direct labor hours that it was going to take to produce one unit. They've given you the standard variable overhead rate. They've given you the actual variable overhead cost, and they've given you the actual hours worked. When we're calculating the total variable overhead variance, we're going to start with our actual variable factory overhead, and that was given. So the actual variable factory overhead less your budgeted variable factory overhead. The budgeted variable factory overhead is variable factory overhead is found by taking the standard variable overhead rate and multiplying it by the standard hours for actual production. They gave you the standard variable overhead rate. The standard variable overhead rate was $3.40, but they did not give you the standard hours for actual production. You had to find those. And to find the standard hours for actual production, we're going to take the time that it takes to produce one unit and multiply it by the actual units produced. And this will give us our standard hours. So the standard variable overhead rate was $3.40 times our standard hours of 26,200 will give you the budgeted amount of $89,080. Our actual was less than our budgeted amount, so we have a favorable variance for the difference between these two, which is $410. So when you're calculating the controllable variance or the total overhead variance, it's simply taking your actual variable factory overhead and comparing it to your budgeted variable factory overhead. It's important that you know how to get standard hours. They gave you the standard rate, multiply the two of those together to get the budgeted amount. Compare the budgeted amount to the actual amount, and it will tell you that this variance is favorable. They also gave you a what if analysis on this problem. What if the actual production had been 129,600 units? How would that affect the total variable overhead variance? So what I did is I just copied my formulas down again, and this time we're going to take the actual variable overhead, which was given, it didn't change, and we're going to multiply the standard variable overhead rate, which didn't change either, times the standard hours for actual production, which didn't really change either. So what you got in cell address B9, which was given, the $3.40, is going to be multiplied by B35, which was your standard hours. Our standard hours would change because the actual units produced changed. It was still 2 parts of an hour that it takes to produce one unit, but the actual units produced changed, so that makes the standard hours change. If the standard hours change, then the budget amount's going to change. The difference between your actual and your budgeted amount still gives you the variance, but this time it's unfavorable at 542,000. And that's all I want to talk to you about today. I'll talk with you again another time. Bye-bye.